My name is Steve Mena. I'm the partner in charge of our Dallas office at Rothstein Cass for at least, the next few days until we are now going to be part of KPMG, and we're looking forward to that. We have a great panel that's going to start us off here today. The panel is entitled Redefining Risk Management and Thinking Outside the Box. A number of great individuals on this panel. On the panel first is Mark Guinney, Managing Director and Head of the Investment Team at the Presidio Group. He leads a team of analysts responsible for the asset liability modeling, money manager due diligence and selection, risk management, and portfolio management. Second is Sharon Snow. She's the CEO of Metropolitan Capital Strategies, focusing on the business development initiatives as well as serving on the investment committee. Sharon provides vital leadership to the launch of the firm's hedge fund and the implementation of the accompanying sales and marketing efforts. And last on the panel is Richard Vigilante. He is the Chief Communications Officer for White Box Advisors, which he joined in 2002. Richard is responsible for articulating White Box advisor principles and investment ideas into clear and compelling messages, and for ensuring that these messages reach their intended audiences effectively. And moderating the panel is Rachel Minard. She is the founder and CEO of Minard Capital LLC, the first full-service global marketing and asset-raising firm that is not a third-party marketer. Minard Capital is a supplement or replacement for global marketing teams to help identify, qualify, and grow new businesses. So with that, I'm going to turn it over to our panelists and Rachel to start the first session. Thanks.
Hello. Thank you all very much for making the time today to meet with us. It's a pleasure to see many familiar faces again. And as you all know, Hedge World does such a great job in galvanizing people together for important themes that I think we all need to address and discuss. If you were outside all of an hour ago, we've actually done this entire discussion over breakfast. So by this point, we should be old veterans of the topic. I actually worked with Thomson Reuters to construct the topic really based on the changing tide of the institutional and private client business in the context of the old days to the new. Many of you may remember, if you've been in the business 5 years or 25 years, that the investment process page that you all have in your marketing presentations usually started with some macro theme or bottom-up fundamental research and then found its way to portfolio construction. Risk management was at the very last box, bottom right, if you remember, under monitoring and risk management. And so the purpose of our discussion today is to first introduce, or allow my panels to introduce themselves a bit more in the context of their role at the firm and what their firm does. And then we're going to go right into this discussion specifically around redefining risk. What is that definition today in the context of not only raising assets and servicing clients, but setting expectations? So with that, I'm going to start out with Mark Guinney. These are all personal friends of mine that I trust implicitly with their insight and guidance in the market. So I'm thrilled and honored to have them here. I'm going to start with Mark and have him maybe talk a bit more about Presidio in that context, do the same with Sharon and Richard, and then get right into their investment principles that are the cornerstone of how they think about portfolio management and their jobs as acting fiduciaries for assets. I'll start with Mark.
All right, am I on? Okay. Mark Guinney, I'm the Chief Investment Officer for the Presidio Group. We're a 15-year-old firm out of San Francisco that we're not in the Presidio, unfortunately. And effectively, you can think of us as an outsourced Chief Investment Officer for high net worth families, which often has its own prejudices. People often think that if you're working with individuals, it's not as sophisticated of an investment strategy. I think before the term was more commonly adopted, you could loosely say we follow more of an endowment model, which in our definition basically means we're more unconstrained in where we find opportunities and how we go about investing. Less rigid than I think you'd find in most institutional platforms. And I would say a little broader in terms of its sophistication and the use of risk management and portfolio management techniques than you often find with your traditional retail or other high net worth operations. So I'll stop there. $4.2 billion in assets under advisement with about 150 different families. And we invest in basically anything, all asset classes, all strategies. Our only rules, we have no rules.
Sharon?
So my firm is Metropolitan Capital. We're a family office, and we also are a money manager for individuals and institutions. We take managing risk very seriously. We started our entire company based on managing investment risk. We think differently as well, and to Mark's point, we are entirely unconstrained to the point that we can be risk off or risk on, which does scare people, I understand. And we take a long-term time frame. So we started with the premise that we're managing our own money for the rest of our life, and when we deal with institutions or other families and family offices for the rest of their entity's life. And it creates an entirely different way of thinking that we'll discuss on the panel.
Richard?
Richard Vigilante from White Box Advisors. White Box was founded 14 years ago by Andy Redleaf, who has been my friend and intellectual partner for almost 40 years, which explains why I'm there. White Box is a multi-strategy, relative value-oriented arbitrage shop. We also think that we think differently about risk. The firm is governed according to a set of 10 investment principles. And the first one of those principles is that the source of an investment return is the efficient reduction of risk, which if you think about it, is the exact opposite of what you learned in business school, right? In business school, we all learned on the Markowitz paradigm that the way we increase investment return is to efficiently increase risk, right? The manager constructs an efficiently diversified portfolio. Beyond that, diversification cannot go. And then the only lever left to him is leverage, is the volatility of the return. So he doesn't increase risk randomly or foolishly, but it's understood in the modern portfolio model that what we do is build an efficient portfolio and then raise or lower the risk on it. We exactly 100% reject that. We think the point and purpose of alternative investing is to use the toolbox of alternative investing, hedging, broadly speaking, to efficiently reduce the risk in an investment. And that's how we believe we make money for our investors. And we'll elaborate on that as the panel goes on, I suppose.
Indeed, indeed. Thank you. I'm going to actually start with Mark, having been in many meetings with Mark for the better part of well over a decade. The question that he very thoughtfully asks the manager on the other side of the table is, how do you define risk? And so I'd be curious to elaborate on that, because most people don't know how to answer that right away. They kind of stumble to find the words, and when they do, oftentimes it's something that maybe doesn't, unlike White Box, tie back to investment principles. It's something that is kind of either ethereal or something they think they're supposed to say. So I'd be curious to elaborate a bit more on that changing tide, even post-08, of how many of the people that are wooing you for potential new investment are thinking about risk, and maybe potentially where some of them may have it wrong.
Well, so one of the things I love about our business is we don't manage product in-house, and so we're unfettered into where we go about looking for return. That goes back to what I was saying earlier. We'll invest in anything as long as there's a compelling reason for investing in that manager, and that includes beta. We're fine with beta. One of the nice things about having high net worth individuals is you have almost a perfect alignment of interests. We're not dealing with committees who we know are going to rotate off, so really don't have that alignment of being able to invest for the long term. So but as we're looking for money managers, it really, the risk has to do with, do they have great insight on something some aspect of the marketplace or a talent. We're investors in Whitebox as an example, a talent for being able to sniff out asymmetric opportunities. So in our minds, that's really the risk, because it does go, and I know Sharon will probably talk about this idea of compounding. The way you're going to compound with any sort of excess levels beyond just the beta of the marketplace is having a certain level of talent. And that talent has to be finding in itself asymmetric opportunities. And so one of the litmus tests we often focus on when we first sit down with a new manager is basically how do they present themselves, and if they're focusing on things like Sharpe ratios and managing volatility and things at that level, that right there often is a litmus test that they're focusing on all the wrong things. We're focusing on the returns. And I think something we were always reminded, I think Warren Buffett said a long time ago, take a lumpy 12% over a smooth 8% all day long. We're of the same mind. Can you get an abnormal return where volatility in itself is, I find, to be not terribly interesting. It's not a measure of much in our minds. So we let the returns take care of themselves to the degree that the manager themselves has some sort of edge, competitive advantage, and maybe just simply be talent, something you really can't quantify. So those are the things that we focus on preliminarily.
Great. Thank you. Sharon,
Rachel,
yes, please. Of course.
Gloss on that a little
Of course,
bit?
please.
Mark spoke about the job of a talented manager being to find asymmetric situations, and we very much believe in that. Again, I'd go to the core of alternative investing is the ability to find those, or indeed synthesize those asymmetric situations when they're not actually found in nature, right? I mean, Ben Graham wrote about his net nets, where he could basically buy a dollar for 50 cents. But he was writing in the midst of the Depression. Genuinely asymmetric positions are rare in nature, right? The point of alternative investing is, again, to use that hedging toolbox to synthesize asymmetric situations when they're not actually found in reality. The challenge of long-only or conventional investing is that the market sets the menu for you, right? The job of the alternative investor is to rewrite that menu by effectively synthesizing securities that don't actually exist in nature, and not only observing, but creating asymmetric opportunities. And again, I think that's the heart of what we do.
Agreed. Thank you. Sharon, one of the things that you and your CIO, Dave Schomburg, do is decide in many ways how and when to have market exposure at all. The interest to actually de-risk by choosing to recuse yourself from the market as appropriate, and then determine how and when to get back in. That's very different than most asset managers who feel, or institutions who feel, the obligation to be invested in any capacity. And maybe you could explain your thought process on that in the context of how you manage risk.
Absolutely. We define risk as managing uncertainty that leads to the permanent or temporary loss of capital. And as Mark put it, we want to compound returns. The goal of any investor should be to compound returns. And in today's environment, it's extremely difficult to do that, whether you're employing a modern portfolio theory, as most of us on the panel, we're here because we think outside the box and reject traditional views. No, doesn't work, hasn't worked, and it's evidenced by history in the past, pick a time frame, 20 years, whatever. So all of us have to take what we learned and apply it in a different manner. One of the first things that I realized when I was beginning my career is that most managers are constrained by the fact they have to be in the market, and we reject that idea fully. The second is that you need to asset allocate. So our firm prides ourselves, and as Mark said, the ability of a good manager is to bring home the alpha, to come out with the money and keep it. So we define our success by the ability to enter the markets and exit successfully, keep the profits, and like a stair-step approach, continue to grow our portfolio. And it's in judgment, Rachel. So everything that we do, whether it's running our algorithms to define our confidence, and then using the judgment of what is the economic environment that we're in, what's the monetary and fiscal policy that's affecting that environment, all of those things that we do every day goes into our investment philosophy and our methodology and approach of managing money.
From what I understand, you look at economic, technical, and fundamental factors. Those are the three overall criteria that build the conviction that prompts you to get in. In the last many months, which of those have fallen short most?
Most are the economic indicators. Contrary to public belief and what the media would lead you to believe, our economy is doing very poorly, as evidenced by GDP, as evidenced by, I could go on, we really monitor 25 economic indicators. And really in the equity world, the fundamentals of most companies are poor. Revenues are stagnant 7 years after the big meltdown. And the only great metric is earnings per share, which is highly manipulated by stock buybacks. So it's a risky environment, and unfortunately, in what we see by evidence, a lot of institutional investors have not really changed their philosophy and approach, and we're going to see what happens in the next few years as stimulus is pulled out.
I've had the opportunity to spend some time in White Box's Minneapolis headquarters, and if you ever have that opportunity and Richard gives you the tour, you'll see something emblazoned on the wall, which are your 10 investment principles. Maybe you could talk about when those were conceived and how your firm rallies around them, because since they're really the cornerstone of how you think about risk.
Sure. Well, we really do. We have 10 investment principles, and it's shockingly not a marketing ploy. They were internal to the company before we ever mentioned them to anyone on the outside. They come out of a philosophy of investment that we've been honing for many years. But a few years ago, we decided to reduce them to 10 principles, and we actually have them. Every investment professional has a what do you call it when they glaze it?
Right, laminated.
Laminated. It has a laminated copy of it on their desk. But we also have them in both our Minneapolis and Austin offices on these gigantic stainless steel engraved signs, so that if you come into the office, you can't avoid seeing them. I mentioned the first principle, which is that we believe that the source of investment return is the efficient reduction of risk. That I happen to have a copy with me. The second, oh, that's not them. The second principle is know the drivers of your investment, maximize exposure to the mispricing, and minimize exposure to everything else. And this is actually, with respect, why we don't have to think about risk on or risk off, right? Because our view is not that we're going to be in the market or out of the market. Our view is that there are always dozens of markets, right? I mean, the beauty of multi-strategy is that you never have to say, I'm out of the market. There's always something to do. And what we do is we identify an anomaly, a mispricing in the market. Suppose we think that there's something about a retail company that we love. There's some particular X factor. And suppose we're right? And it's kind of easy to be right about the outstanding qualities of a company. Lots of people might have this same insight. That's not so hard. The hard thing is getting paid, right? Because I may be right about the X factor, and I may go out and buy that stock, and then I may find out that I haven't bought the X factor, I've bought the weather, because it's a retail company. Or I've bought GDP, because it's a retail company. Or I've bought 15 other different factors, right? So the reason that we don't have to be risk on and risk off is that we view our job as isolating the desirable factors and therefore getting paid almost regardless of market conditions, right? It's the where there are firms that are very good at being in or out of the market. We view our prime skill as moving around in the market, right? We're multi-strategy, not in the sense of running 5 or 6 strategies, always more or less allocated the same. We're multi-strategy in the sense of being highly dynamic, in that we may be running a strategy very vigorously today that we never ran at all 2 years ago. About a year ago, we had 2% of our multi-strategy fund in municipal bonds. A few months ago, we had 14% of it, because municipal bonds became an area of opportunity. And we didn't have to worry so much about being risk off or being risk on or being in the market or out of the market, because a new market, right, had emerged in disorderly behavior in the municipal bond market due to headline risk, right? That's a temporary phenomenon. We're in it now. We may not be in it a year from now. So that's kind of how we get away from the risk on, risk off obligation. We think that there's always something to do.
Something Richard mentioned, I think that's it's important, and I think this is the big challenge for allocators or fiduciaries, and he really, I think, hit the nail on the head, and that is understanding risk means more things can happen than actually will, and it's understanding, well, did the manager have insight and it just didn't work out versus, well, let's say, being lucky and being right. And so the understanding ex ante, what are the reasons for this investment and all the things that could go wrong and were right. Separating that from what I think most people do, which is sort of reductive, backward-looking focus on performance, I think tells you very, very little about whether there's talent. And so I'm going to challenge one thing that Richard said, and that is this whole idea of that you have to go to alternatives to find this level of talent, I think is a fallacy. Especially, I think the whole world, the word itself has become oxymoronic when everyone's doing it. How could it be alternative? And then I think it was just the Wall Street Journal today. I think it just had a whole article about how so many institutions have missed out on the equity rally because they've all rallied around this whole idea of alternative, which again I'm struggling to even define these days. But I do think that there's a huge agency problem in that, we were talking about this earlier, in that most managers get put in a box to resemble some sort of homogeneous set of characteristics. And I don't think you could really do that. And I think that's what's shifted, and that's why what's given such rise to this whole idea of alternatives is because at least some element of sort of unshackling the manager. Now, one thing I think we pride ourselves on very well is finding that long-only manager who thinks very different, who is unshackled, doesn't manage the benchmarks, doesn't even know what the benchmarks are, isn't trying to match the sector weighting or the geographic weighting or the industry or security and then the like. But here's the real rub of it. One, it's very hard to do. It's hard to find these individuals and themselves having a client base that allows them to do it. But presuming you can, here's the real benefit. Well, there's two benefits. Actually, one, you can often get away with only getting charged 50 basis points as opposed to 2 and 20. So the frictional costs are dramatically less. But the second benefit is I don't have to be binary in making a decision on being in or out. If I have a manager that can find these and tilt towards where they think that the asymmetry is, including going to cash, and I could do that with a whole host of money managers, then I don't have to rely on my own sort of biases or prejudices and have to be right twice, that is, being in or out and then going back in or out. And so that's effectively what we try to do is find a whole series of managers who sort of think in an unorthodox fashion where the agency effects are much more aligned with what we do. and I'll let them do it. Now, it's almost impossible to find managers who completely don't have the influences of their institutional investors, if they have any, in which case we have to take into account their own biases, and where they start to manage different than their own conviction, then we have to do it ourselves. And that's where we'll either terminate them or take money away from them or give more money to them.
And if I can
Please.
cut in too, I mean, just to add on to that, as Mark said, there's plenty of managers that do it a different way, and Richard and I try to accomplish the same goals in a totally different manner. So I like to challenge one aspect of what we're talking about, which is in or out, because there is no out. So really, you're moving from a higher risk to a lower risk. And this was evidenced in the meltdown when the reserve fund, which was a money market fund, broke the buck. You don't lose 3% of your investment by being out of the market. So in our firm, we do what other managers do to a larger degree. We move larger parts of our portfolio, not 14%, sometimes it's 50 to 100% of our portfolio, into a higher risk investment to capture that alpha. And you know, there's a lot of ways to skin a cat, and all of us do it differently.
So I think
please.
Sharon and Mark both make good points. And Mark, you're right. There are long-only managers who excel at this. And moreover, at any given point, a third or more of our own portfolio has no individual hedge. The problem is that it's hard to find those positions outside of general market disorder, or a specific, or some, you know, specific sub-market disorder that's going on. It's just hard, right? Most of our unhedged positions, for instance, are in distressed, which is, you know, there is effectively no market there. So it becomes more feasible to develop an asymmetric long-only position. But I also liked your earlier point about knowing why you've won or lost. Right? We have a saying at Whitebox that there are two ways of doing stupid things. You can do stupid things on purpose, or you can do stupid things by accident. And doing stupid things on purpose is okay, right? If you know why you did it, if you had a reason for doing it and you turned out to be wrong, you're not fired. But doing stupid things on purpose means that you insufficiently elucidated the risks before you started. And that's really unforgivable.
Yeah, and actually and this is what I think the allocator industry does a very poor job of. They rely on these risk reports that tell them a lot of data but no real information. And so, sort of to Richard's point, to separate the difference between that, in our minds, there's no substitute for speaking with the decision makers on a sort of an ex-ante or real-time basis, you know, close enough to understand, well, what is the insight they're looking to take advantage of. Exactly. In their case, they're usually, Whitebox is looking to find something a little bit more wholesale, muni bonds as an example. With our long-only managers, this is one of the reasons why we end up with 20 stock portfolios, as an example, sort of the exact opposite. And it's not looking to take advantage of a broad base. In fact, I really don't think you could really do that in a long-only fashion, to find 100 or 500 or 1,000 different securities that are being mispriced. But can you find 15 at any particular point? I think you can. But there's going to be a lot of noise along the way. So how do you know whether there's skill or luck? You understand why those 15, what is the insight that they have to that X factor for that retail company, knowing that weather could absolutely, in fact, I'm reminded of a situation several years ago where we had a manager at a very concentrated position in disk drive makers, Western Digital, forgetting some of the other names. And then what happened? Well, there was a big flood in Thailand. Well, that's where a lot of their manufacturing bases was. Stock price falls. A lot of people thought, well, you know, there's a problem. The manager didn't have any great insight. Well, that was weather. That was a risk to invest in that strategy. Now, certainly these stocks rebounded and then some months later. But it is understanding the difference between the insight the manager have and all these externalities, especially in the short term. And this is, I think, the challenge, especially for hedge funds, because their client base has a very short-term focus. They expect that alpha to be driven in a matter of months, weeks, or days in some instances. This is where you have to have the agency alignment, where I don't think a lot of our strategies are really appropriate, because we're thinking more in terms of years.
Mark,
than it is
it's not
weeks.
true if you find the right clients.
Well, that's exactly right, and I think that's the big challenge. Is and I think you can take this back to performance measurement, which don't get me started there. But I think you can measure everything in a matter of weeks and months, and I think unfortunately allocators do that these days, and the fiduciaries and the decision makers, and they're very quick on the trigger to justify why this manager, when they're quote underperforming some index in the short term. And I think that's the only true sort of advantage managers have these days. If you don't got the computing power of a Renaissance or D. Shaw or what have you, you have to be able to take advantage of the time arbitrage.
We did a conversation like this with Richard's colleague Andy Redleaf and also with Mark Lasry in New York a few months ago. And when asking Mark specifically what is the biggest risk in investing in hedge funds, having watched his business grow exponentially, it was reputational risk. We got into more detail of that, and if you remember the 80s and 90s, the classic portfolio construction or asset allocation was 60-40, then 60-20-20, to which alternatives came in. Then you may remember the shifting tide to alpha beta. Do you remember those conversations? And in fact, you'd watch the Rokitans and even some pension consultants change their manager risk and research teams specific to what was going to hedge liability, what was going to generate alpha, and what was going to be an inflation hedge. That then changed, if you remember in 08, it changed to liquid and illiquid. So you'd actually go into meetings where you had an entire team dedicated to more liquid instruments. That then changed yet again to transparent and opaque, where you actually had, you might look at, any of the Tudor, Caxton, Brevin, any of the classic macro guys that were discrete and discretionary versus the quant guys like an AQR and D. Shaw that had more of the perceptional black box side. Now you're at a point, watching this entire trajectory over the last 20 years, that is now the quality of the instrument itself. It's based on the characteristic of what is the fund designed to do, and very much to what we're hearing all the way down, agnostic in many ways to the way one thought, is now what is the objective, not only of the instruments one's using, but what the fund is designed to do, what is its job. So from a marketing perspective as well, we're entering into discussions differently. It really comes back to, which was our whole point of our panel today, the investment principles. To which does one hold dear? What are the key tenets that the investment team or the risk team need to adhere? Because then, to Mark's point and to the rest of the panel's point, you understand the modus operandi behind the impetus and behavior of the investment team that make the decisions that they do. And very much back to Mark's point as well, and he and I have seen this in decades, is risk management oftentimes doesn't take into account the inclination or the objective underneath and behind the impetus for the numbers. And so it takes that information in and of itself is fine, but you really today are investing in a business, not just a return stream and not just a fund. Especially when looking at operational business, headline, all the major 4 risks of hedge fund investing, for which investing is just one. You really are beholden to a much greater standard, and it is your obligation to be able to speak to, as you've heard here, the impetus and the investment principles that are underlying the decisions made. Maybe actually, Mark, back to that point, we were talking about the box. So many pension consultants still, and even intermediaries, are trying to figure out what box one fits in. Even large endowments, even here in town. That's the conundrum. And mostly it's because of non-correlation and or correlation, right? What is the behavior of that instrument relative to what else is in my book, so that I can determine how to size it, how to weight it, what its expression or what its result may be, so that I can be much more tactical in constructing a portfolio. So maybe to your point, because you've had the benefit of your focus on knowing why and being agnostic in many ways and open to any strategy, that must give you a much larger berth and larger wake by which to decide where the opportunities lay that might be unique.
Well, and to that point, the conversation we have with all managers is I don't care what you call something, I want to know what you actually own.
Right.
A manager that is 50% cash is not the same thing as a manager that's fully invested at that particular time. Now, Rachel talked about where a manager's biases will lead them to, the sort of the pond that they may tend to fish in. White box is sort of the exception to the rule in the types of managers in that they can go anywhere and everywhere. We have to be very diligent to understand, well, where are those weights are to make sure we're not overly duplicative, that we have our other managers also in that same place, because again, always worrying about that worst case scenario that everything's in a great opportunity and yet some sort of exogenous shock were to happen that would create that permanent loss of capital. So we always start with, at the manager level, is what do you actually own and what are the characteristics of those securities that would lead to these, the variety of outcomes. Back to risk means more things can happen than will. And sort of to Sharon's point, not trying to be anchored to labels or some sort of homogeneous characteristics because it's called fixed income or called the money market. And I find it really, really fascinating these days that people still go to these labels, especially as it relates to liquidity, which I think is going to become the next really big issue. Look at the Japanese JGB market. It's the biggest in the world, bigger than even our U.S. Treasury market. And yet you had a moment a couple of months ago where the 10-year JGB didn't trade for 2 days. Is that liquid? And yet there's this presumption that a market like that is very, very liquid. It could happen easily with the U.S. Treasury market. This is a presumption of liquidity. So it's back to, you got to understand the price that you're paying for it and what is different or possibly unique about this security on a going forward basis that is different than perhaps it has historically. Just because U.S. Treasuries have traditionally been very, very liquid for most of its life doesn't mean it necessarily will on a going forward basis.
Well, to your point before as well, Sharon, not only are you looking at what seems to be the direct impact or influence of a market and or of sentiment to something, but you're also looking at the secondary and tertiary impacts of something. Maybe you could give a recent example of any idea that you and Dave have thought through and the implications far and away beyond what the average person reading the journal would be able to identify, where you've actually thought through that in a different level.
Sure, absolutely. I mean, I think, Mark, you're exactly correct. When you look at Japan, there's a lot of risk, and in fact, our analysis shows that that could be the next seize in the credit markets, could begin with Japan. It doesn't mean it will. So you monitor your inputs all the time. But recently, a lot of people have put on a short treasury trade, and they've been early, and there's been a lot of noise in the press about that. They lost money by not doing their homework and not being early. We've been monitoring that trade, and to go back to the binary on or off, that's how we all get paid. Whether Richard does it with 100 different instruments, or you in the audience are in private equity or leveraged buyouts and do it with one company, we all get paid putting that trade on and exiting with the money. And that's how we get paid. So for us, it's waiting for the treasury trade to materialize, to be able to short the treasuries when yields go up. It hasn't happened yet. So patiently, we wait for that to materialize, and I think that's what you're talking about.
Indeed, indeed. Yep, that's a good example. So one more point, Sharon, you brought up earlier too, is we were talking about the the fundamental factors specifically. I know when we were talking last night, you were explaining how kind of the often naivete for investors, specifically thinking about market sentiment, the momentum of a market toward an idea, toward a trade, and how you really need to step back and really try to figure out what is prompting that momentum, what is prompting that drive toward seeming interest in an investment. Maybe you could think of one or two other examples that you and David looked at recently that just by default of perceptional interest, it's actually that very thing that prompts you to say, this is an overcrowded trade, this is something that I think might not be of interest, whether it's the Teslas of the world or whatever.
Sure, I mean the U.S. equity market in general, let's use that. With volume as low as it is today, and the fact that you know, S&P companies are buying back their own stock at unprecedented levels. I think it's $500 billion now, and they'll buy that stock back at any price. There's a point where that cannot continue, and when that tipping point tips over, who are the buyers? And that's Mark's point about systemic risk in the JGBs. When something stops trading and there is no market, that's when people are concerned. We want to be aware of that before it happens. And we're looking to go where the puck is. A simple analogy, Wayne Gretzky, go where the puck is. So if we have to wait and not be, say, in U.S. equities, because it doesn't make sense from an economic and fundamental standpoint, we're willing to look wrong and go from a hero to a zero, where other people want to tout their acumen until the market turns, and then they blame the market. So we truly think outside the box and have an entirely different approach.
And I think you see that too, Mark, for yourself, particularly when doing a final assessment of a manager. What would you say is the kind of most disappointing factor? Is it that people are typically placating, they tell you what they need to hear versus having the evidence to support it? What do you think is the fatal flaw for those that are trying to justify their edge in risk management?
Well, having interviewed probably thousands of managers in the last 15 years, one of the things we do, we like to find managers when they're very early in their life cycle, before they have a marketing person or IR. You get those portfolio managers when they haven't been trained on the audience, of what the audience wants to hear, as opposed to really what they do. And so I find it very problematic when you find these managers later in their life cycle, because they've been trained on sort of a script. And so you get these portfolio managers when they're early, and they just want to talk investments. And so that's why we tend to gravitate towards these earlier in life cycle money managers.
Makes sense. We've, on behalf of Hedge World, we've decided not to move forward with Q&A, just to keep it a steady pace, but I did want to and ask that you kindly join me in thanking our esteemed panelists, Richard Vigilante from Whitebox, Sharon Snow from Metropolitan Capital, and Mark Guinney from the Presidio Group in San Francisco. Thank you very much.